Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data Podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success. Jez, part 3 of our property v shares. What would we do?
Can I start reading the disclaimer?
Yes, you go for it.
The information provided today is general in nature and does not take into account your personal financial circumstances, objectives, or needs. Please seek professional advice before making any investment decisions.
Great. And I think we always say educate yourself.
Yeah.
That's the thing. You can listen to financial planners, all these experts, but yet at the end of the day, no one is going to look after you like you.
That's right.
Look after your own money. No one's going to really care.
My mum cares.
Not care. I mean, let me rephrase that. It's like no one's going to look after your money like you would.
Yeah.
So I think the last episode we spoke a lot about sort of leveraging, I think, shares, leveraging property. We looked at it like that. If we had $100,000, where would we move our money? Or look at comparisons, I guess. Like what are the ROI returns? And I guess looking at that sort of 30-year period, shares weren't that far behind. If you compared it to like, the VAS, which is the top 300, it's an index, the top 300 companies in Australia bundled up into this index fund. It was very close, wasn't it?
Yeah. One of the things we didn't really touch on was unleveraged. It didn't look so attractive when you look at the return on investment, but when you are unleveraged, I assume your strategy is to trade the small caps, the penny stocks, and then you might be able to land one cracker deal or something. But I'm curious to see how much you would need in terms of capital growth to match the leveraged ones where we had something like 12.5%. Anyway, if we've got time to fit that in, that'd be great to see.
Well, you could easily work it out. Like you just need a higher return, don't you? So like let's say the VAS is at 9.5%, but if it's leverage, your ROI is 11.5. There's a 2% difference. So you need to try and get that from maybe the smaller caps or take more risk on. But I think you always have to bring it back to your own circumstances. And you got to remember, if you're leveraging, you're taking on risk. If you're a little bit away from retirement or you're ready just to take it easy or reduce your workload, do you need all that unnecessary risk? Because it's so easy just to go, keep going, build wealth. But sometimes you got to sit back. What's it all for?
Yeah, that's right. Yeah.
I notice it a lot with the business. It takes up a lot of time, and you've got your investments, your personal life, and it's all about that balancing act. At the end of the day, you want to have free time to do the things that you want to do and just find that nice sort of flexibility in your lifestyle. At the end of the day, if you work too much, your relationship gets impacted. I don't want to sound like a life coach now, but you know what I mean? Like, what's the whole reason behind this? Because I have to ask myself, you know what? I've worked hard. It's time to start enjoying, and I forget that.
Yep. Yeah, good point.
So I think one thing I wanted to discuss, we've obviously discussed the property, the shares, the leverage, but one thing I wanted to touch on is, from all my experience doing initial consultations, seeing clients' circumstances, I noticed that they might have their owner-occupier, they might have their investment, but then what they do is they might buy some shares, index funds, maybe put a couple thousand here, a couple thousand there. But it's like, why wouldn't you just move money into your offset account on your owner-occupier loan that's not tax deductible, or just pay off that loan? If you're planning on being there forever, you might start slowly paying it down. That's what a lot of people do. If it's your own home, you're more than likely on principal and interest. True? So I just wanted to say, okay, well, you need to factor that in, because let's say your interest rate on your home is 6% per annum. That's the return I'm getting on my money, 6% after tax. Not a bad return, risk-free.
Yeah, that's the big deal, isn't it? It's risk-free.
That's the thing, because you don't think about it. It's like, why would I go buy VAS and maybe look, the markets are really strong at the moment. If you have a look, they're at the sort of all-time highs, and I'm all for diversifying, but it was very rare that I saw someone have their owner-occupier loan and they'd have so much exposure to like shares. besides their super, like in their own name, their primary goal is to build up equity and have that home paid down quicker, or at least offset, because you're getting a risk-free return. Where with that VAS, that ROI figure of 9.5%, like that index fund, that's growth and yield. So you pay tax on any capital gain or any yield, your return drops. Where I'm getting 6% without any risk.
Without any risk and without any tax.
No risk.
And as far as time, like it's not active at all. It's like just, put it in there and forget about it.
Well, that's the thing. How would you value time? Everyone's different. I guess it's like, what would you charge your time out to be? Because I'm trying to get in the whole outsourcing thing, but it's a little bit difficult. But there are certain things where I'm like, if I can save time, I try and do it. But you're right, like 6%, not even thinking about it, not wasting any time. It's very good to have that type of exposure towards that if that's a part of your strategy. But I just wanted to bring that up because that leverage property in episode or part 2 of our series, you had about that 12% ROI conservatively, average. Where as investors, we're going for closer to that 20% mark because we want to beat the average. But even that, like a leveraged, VAS, for example, if you leverage it, which I'll show in the slides coming up, 11.4, still not much difference to that 6%. Maybe over time it would make a difference, but that risk-free when the rates are a little bit higher, it's quite compelling, isn't it?
Yeah. I mean, when you mentioned we're looking to outperform, I think this is a good spread that you've got here for the mug punter, just the mum and dad investor. If you are worried, you've always got this fallback of whatever your interest rate is on your mortgage. There you go. There's your risk-free. There is a case where it's not risk-free. If your offset is larger than your loan.
That's a good point, which I've actually seen.
Yeah. So if you have a $300,000 offset and a $200,000 loan, the bank's got $100,000 of your money.
Earning 0%. And I have seen that.
Yeah.
I've seen ones where people have had their owner-occupier loan, for example, like 6%, they could just have that in the offset. Then they got a savings account at 1%. It's like, why have you got money in a savings account? It should all be in the offset account. It's like lazy money. You just have to think of your cash as employees. They're working for you,
Yeah, get them working harder.
Get them working. So I think you could always, depending on the way that you look at it, you can find the best structure for yourself. So you might go, look, I want to allocate a little bit towards just having cash as backup. If the market goes down, I like to have a bit of money ready to go. Like it's always good to have a bit of backup cash. And the percentage you need to work out for yourself, but you just have to work out, because having percentages, you can sort of always rebalance your asset allocation. Do you have more cash? Do I try and get more exposure to property? Do I buy more shares? So it's all personal preference. Moving forward, so this was an example that we looked at last time with that $100,000 property. We've got that ROI of around 12%. So that rough profit estimate of about $12,000 based on our $100,000 of cash that we're utilizing, we're getting a 12% return, give or take, on bulk standard. Now, if we did that with the Vanguard as an example, a little bit lower, it's around 11.4. So 11.4, again, we factor in the growth rate yield since inception 2009 of the VAS being leveraged, but again, not too far off because we're utilizing that power of leverage. So instead of buying 100,000, we've gone to a 60% LVR. But the premise here is, we've put 100,000 in. It's not costing us much from a cash flow. We're about, $1,000 behind every year, $20 a week, give or take. But it's the growth that we're after. So being able to invest more, you've got more exposure. But if you get 0% growth or negative growth, that'll bring you back. So if I guess time sort of can help with this, but if you're trying to get in and out really quickly, there are some risks to that, isn't there? Because if the market comes back, well, you're going to be behind. That ROI number is going to be negative. So it amplifies your returns and your losses.
Yeah, and it kind of locks you into the average. Trying to get ahead when you are in a very diversified indexed fund, that's unlikely to happen.
That's right. And then if you have a look at the next part is like, what would we do if we started? Again, Jez.
Yeah. Well,
What
I
would
think
you do?
I'd focus on identifying the key traits of the born marketers, because if you can avoid all the manipulations, the emotional manipulations of marketing, I think that would stand you in good stead. I think that the trickiest part about property investing is recognizing, um, marketing versus genuine insight, because there's an enormous amount of fluff and BS that's just packaged up as insightful content, and it is really just marketing.
Well, I think years ago I got roped in. I think I've mentioned this many times, like around 2014, 15, 16, I got roped in. But then after, working in the industry, seeing different things, it's like, okay, you start learning, and that takes time and experience. And we're trying to share what we've learned so people and listeners are more aware, because at the end of the day, there's a lot of good people out there and not so good people that are just trying to make a lot of money. But at the end of the day, you need to work out what's best for you, educate yourself, and maybe try different things. Like try what works for you, what doesn't work for you, and try and figure it out. Because at the end of the day, that's what you have to do. There's a bit of trial and error.
Yeah, and the second thing that I think I would focus on is, I think I would, if I started again, I would start in shares, because I wouldn't have enough money to buy a property. And my focus would not be on growth. It would be preservation of capital. How do I prevent myself from losing what I've got?
The way I would, if it was me and I was starting all over, let's say I had $0 in the bank, I would try and really work hard to build my deposit up. And I'd mostly do it in a higher interest savings account. That's just me. You might want to buy shares, but I just wouldn't want to risk any of my capital just in case there's like a GFC or COVID event where I just lose 20 or 30%, or let's say 20% of my capital when I'm trying to work towards that first property, because I don't want that risk. I'm trying to work really hard towards that. Again, everyone's different, but I think getting that first property can really help you. And then if you can get that first one right, you get the capital growth, and then everything just works off the back of that first property.
Yeah.
And we've spoken before, you don't need 5, 6, 7, 8, 10 properties. You just got to find that balance of, let's say you've got 2 or 3 quality properties over 10 really cheap, all over the place properties. It's that balance, isn't it?
Yeah, that was my third point. I wouldn't be nearly as aggressive as what I was. I made so many mistakes from just being too aggressive.
What was your big one that you made? You think that being
There's
super aggressive
so
early
many
on?
to choose from.
Number one.
Mistake-wise. I think, well, there was one property that I bought with vendor finance. So all I had to come up with was stamp duty, legal fees. And I'd done the cash flow analysis and return on investment, like that spreadsheet you showed before. And this would have been the most successful investment if I just had as little as 4% capital growth. It went backwards though. And of course that was heavily leveraged because I borrowed everything. I hadn't put anything in. So that was a big one just through aggressive accumulation. But it probably wasn't the most costly. The most costly would have been taking advice from someone that I thought was an expert, and they're just an expert at marketing themselves as an expert.
I think you've mentioned that before. That's like hundreds of thousands of dollars in opportunity cost.
I calculated about $1 million.
That's a lot of money.
Yeah.
Lesson learned. That's what it's all about.
Yeah.
Learn from your lessons. I think that's it. So I think, what's the next slide that we've got? So lessons from our experience, like for me, property first. Look, again, not advice. It's just whatever works for you and how aggressive you want to go and trying to build up your asset base, because that's the idea. You want your net equity to grow, and it just depends on what your goals are. A lot of people are comfortable working till 60, having access to their super, but at the end of the day, the best thing I love about property is, you know what, if things don't work out or I want to retire earlier, you can sell a property and take it easy. I get my time back. I can spend my time in doing things that I actually want to do. So, but I think balance obviously reduces your risk, but obviously requires a bit of portfolio balancing. So again, you just got to work out what is best for you. And look, you might not want property at all. You might just be just shares, and that's okay. It's your opinion, but I know you're heavily more property, aren't you?
Yeah, well, I realised that I didn't know what I was researching within the share market.
Mm.
Things that I thought made perfect sense, well, the market moved the other way, or that particular stock moved the other way. But property seemed to make more sense to me, simply because I'm a human. Humans live in properties, and I've got some idea. But what was happening in the share market required a lot more learning outside what you just naturally acquire by living as a human being.
And you're competing against these professionals that do it day in, day out. Like when you're working full time and trying to learn, it's difficult, isn't it?
Yeah. Well, that's one of the big pluses for property. You can easily outperform that benchmark because that benchmark is established by mums and dads making lifestyle choices, not fund managers using some sophisticated algorithm.
And if we have a look at the next slide, so I guess let's have a look at some of the markets. This is just from CoreLogic, and then we've got this on the right from Google, looking at some of the Vanguard products. I think the ones I've mentioned is like VAS and then VGS on the right-hand side. But you can see on the right-hand side, the markets have been going very strong, all-time highs with the index funds globally and in Australia. So I guess the one thing I just wanted to point out here is that where I got stuck once was just before COVID. I did a lump sum amount, spoke to a financial planner, thought, okay, let's try and work it out. And then I got hit hard around, was that in 2019, 2020, this period here. So I allocated, took a lot of my money out of my offset, allocated it to shares and crypto as a lump sum, didn't leave much in the offset because I was being aggressive and that market tanked. So I went down, 20, 30%. And I didn't have cash to put back in to the market. And I got into a state where I was checking it every day. It consumed a lot of my time. And I just realized I thought I could deal with it. It's easy to say, oh yeah, I can deal with a 20, 30% loss. But when you go through it, it's a big learning lesson. And I don't want that stress anymore from my perspective. So that's why dollar cost averaging is what a lot of people like, from an approach where they go, you know what? $1,000 every month, automate it. It just buys index funds and you just get the averages. Obviously, you have to factor in maybe brokerage costs, but that way it's a good set and forget approach, isn't it? That people can think about. But on the left-hand side, we've got the states. So like Brisbane, Adelaide, Perth at their peak. So this is data from the end of
2024.
2024, no, end of January 2025.
Oh, okay.
So we'll go at the peak. Brisbane, Adelaide, Perth have had obviously great runs, especially if you look at the last 10 years, significant growth. But to point out, I believe that there's still going to be growth in these markets because, look, even though they've had that significant growth, it is slowing down slightly, but it's more than likely still going to have quite a solid year.
Yeah, I think we just need to clarify here. First of all, this is from CoreLogic. And what they're doing is they're looking at a historical chart of the growth of those three markets and saying, it really is, it could be at its peak if it doesn't grow any further. But definitely for Perth, I think there's still plenty more growth there. A lot of commentators are questioning whether Perth is at its peak. I'm not seeing anything in the data to suggest that it's about to peak.
I think a lot of the investors like the yields there, but it's just a matter of the way I think about it. If you're buying now, are you going in for a year? Get in, cash grab, or if you're thinking from a 3 to 4 year horizon, are there better markets? That's the way you need to think about it. So even though we believe those markets will be strong, I believe if you're comparing it over a 3 to 5 year period, there's a better market to invest in.
Yeah, there's more chance
of another area.
Of another area. But if you, like you said, if it's a get in, get out, then there's still opportunities in Perth.
And if you look at Brisbane, Adelaide and Perth, like since COVID, big gains. 70%, 73%, 76%. And obviously Melbourne's at the lower end at 8%. But very interesting when you look at that.
Yeah.
Anything to add to that, Jez?
Well, yeah. I mean, it would be a case of surges and sloughs. This is so typical you see in the property market. There'll be a boom, you see amazing figures, and then it'll just go flat. And by contrast, it's also amazing. I mean, you look at the differences there, say 60, 70% difference. That's an opportunity cost. For a $500,000 property, a 60% difference in growth is over $250,000. It's, $300,000. That's how costly it is getting it wrong.
Well, that's a perfect example there. We've spoken about in the past. You go to, let's say, at COVID, you bought right after COVID in Melbourne, and look at all these other markets that have had significant growth. So you wouldn't be too happy now, would you, if you utilized the buyer's agent and they said Melbourne's the place right after COVID when you had Brisbane, Adelaide, Perth.
Yeah, I mean, do an example now where you sell in one of those three cities. Let's say you've made 70% capital growth. So halve that, because you've held it for more than 12 months, so you're down to 35%. And then you pay CGT at your marginal tax rate on that. You're looking at around about it wouldn't even be 20% in tax. So you've netted 50%, and then you can put that in
to a different market.
Melbourne. You'll put in twice as much as what you would have put in if you had bought in Melbourne at the same time. So, you can't argue the case of, long term it will outperform, or it's too late. Someone's already invested in Perth, they've liquidated, they've brought their equity back to Melbourne, and now they're better off than the investor who started off in Melbourne.
Especially if it was your first investment. So back then, and they could argue, no one can predict, and which no one can, but there were indicators that these other markets were primed to go, correct?
Yeah, I mean, you'd have to be living under a rock.
But that 7.8%, you'd be thinking, let's say that was your first property. The last, 5 years, you've held this property that's barely had any growth whatsoever. How would you feel about that?
Well, I think this might be part of the reason why so many property investors only own one property. They have a bad experience. They either offload or they don't acquire a second one.
Well, I was like that for my first one years ago when I did buy, and it took me forever. I bought the wrong asset in the wrong area, and that's what actually got me. I look at it from two ways. At the time, I was like, why isn't this growing? It was years and years. I'm thinking after 9-10 years, I had maybe I sold it for $30,000, $40,000 profit, nothing. But it got me into property investing. I did accounting. I was doing all these different jobs. I couldn't figure out what I wanted to do. And I just became passionate about it. So in the end, I wouldn't be doing this if it wasn't for that property. I would have never known about you. I would have never, it's amazing where I was to now. I'm still have to pinch myself, very lucky. But back to this, it's just interesting. Again, just do your numbers. And I just wanted to sort of bring these up so you can see sort of how the markets have been performing. And then if you have a look at, actually, before we move on, I'll bring up something and I'll leave a description. So let me just, this was what I had up in the last episode, but let's just bring up the volatility charts. And on this chart, what you can actually do is you can sort of go look at a period and say from, let's just say, let's say 2010 as an example. And you can pick different markets, and then what you can put in when they've had sort of big falls. See that there? So the blue is indicating, what do we say?
Climbing back.
It's recovery, and then you got the falls. So for example, you've got around, obviously I had the GFC, and then around 2015 there was a fall, and then it picked up again, and then we had another fall, picked up again. You can sort of see the recoveries, and you can see sort of the big drops. So have you had any? Okay, so the 20% drop, that's when I got hit pretty hard. But again, there was a recovery, and that's when I was working with a financial planner. And then I worked out, look, I need to take charge of my own portfolio a little bit here.
Okay, so this is a good reason why, you know how you had in one of those spreadsheets a buffer for leveraged investment in shares, it was 60%. So you can get up to 80% LVR, but the LVR you set was 60%. That's to cover this case.
So if I go back even further, let's just say 2000. Okay, so there's obviously a big hit here. That was around the GFC. So the massive drop. So a lot of people were thinking, great, I'm going to get access to my superannuation. Bang. Their super portfolios got hammered through this period. So if you're right close to retirement, you might want to be a bit more conservative with your investments. Do you need to have all this allocation? You might want more yield or more savings. So these are the things you need to sort of work out, but very interesting. So what happened here, I'll touch on it quickly. I had properties and then I'm like, okay, I thought about maybe going again on a property and I was struggling with lending. So I said, you know what, I'll put some money into some shares and crypto. What happened? Bang. But then the market sort of did pick up again. And I tried getting tricky, picking individual stocks, and I learnt my lesson. I've decided that for my best approach is set and forget. And that's what I do now. But I learned the big lesson for me here because I allocated a lot of my cash out of my offset and I had nothing left on the way down. But that taught me a very big lesson in investing. But it was just funny because I thought, oh yeah, I can easily deal with it. And then when you go through it, it's like, maybe that's not for me anymore. I didn't need that stress. Moving forward, so
Yeah, asset allocation.
Asset allocation, we won't touch on this too much. I think, again, you can talk to a financial planner or do your own research. It depends on how aggressive that you want to be. Like if you want to be super aggressive, you could have a lot of exposure to like stocks or property and not much to cash. And then you might sort of adjust it as you go. So these are sort of like maybe general investment principles or guidelines. But again, talk to a financial planner about that or do your own research because like let's say you're heavily invested into one stock. To me, that is huge risk because you're relying, if that company goes bust, and actually some of those properties, I didn't just invest in index funds when that big drop happened. I had stocks, spoke to a financial planner, picked out all these different stocks and a couple of them went bust. But that's the risk. It's not on the planner so much. It's more the fact that I took that risk on and I wasn't ready for that when I thought I was.
Yeah, it's a good plus for property. You know, you don't see a property go to zero.
I just brought this example up because I wanted to show you just to say, look, I could easily show you the investment journey. So since like 2017, the last year has been fantastic. 56% total return on my money from shares. And that's balanced between like maybe shares and index funds. It's a bit of a balance compared to like the Vanguard or the VAS, which has had about a 16% return. So very good, 16% return. If you leverage that, it would have done pretty well because it's had a big run. And as I mentioned, you've got VGS there, which has had an even better run with the international markets. But then I could easily show you this and tell you how good I am. But then I also want to show you from the first purchase, it's been actually very poor. It's been a 0.8% per annum return compared to like the VAS, the Vanguard, at 12.5% per annum from 2017. And this is where use the planner, was buying into managed funds. I didn't keep it simple. I tried to overcomplicate it to get in front and then realized I didn't have the expertise for it. I would have just been better off investing in the index fund and forgetting about it. I would have saved so much time, but I needed to learn that lesson.
Yeah, and this is one of the things that I don't like about the share investing is how difficult it is to outperform the benchmark. So you've gone through that experience. You really do need to have some sort of special gift or serious experience over many years of trying and failing before you can outperform. Because to get the average, you can invest in one of these index funds, but to outperform the average, you have to beat all the other, well, at least 50% of the other investors that are in the market.
And I think it's just the reality of investing sometimes, like you're learning, and if you are in the same boat, like don't stress about it. It's all a part of the journey. And before I used to sort of kick myself a little bit with it all, like just, it's like, I'll give an example, like I almost finished my CPA accounting. So I did my degree and all that, and I didn't finish it. I thought I had to do it. I had to do my CPA, finish it, and I was almost there. I had about maybe 2 or 3 more modules to go. And I'm just like, I was working, I was investing, I had things outside of work. And I just said, I don't really need my CPA, even though it would have looked good on my resume. But I'm like, this is what I do now. This is what I love. I didn't want to inject any more of my time into something that I wasn't passionate about. And the one thing that frustrated me the most about the CPA is like there was an exam I didn't pass. And I'm like, well, I want feedback. How am I going to learn? They just put you in a room and it was just really frustrating. But where I'm getting at is there's that sunk cost bias. Sometimes you got to let things go and then just move on, and that's
Right.
really difficult to
good
do.
one.
And I've done it with my CPA, and I try and tell myself something. If I'm not enjoying it, why am I allocating more time? And I guess with this investing and shares, I did the same thing. Sometimes I said, look, I've lost. Okay, cool, move forward. But I've done well in property.
Mm.
So it's just about
But
don't
maybe just to add to that, you've lost, then learn and move forward. Yeah.
learn from my mistakes,
Yeah.
everyone. I just think keeping things simple is a better way than trying to overcomplicate it sometimes, because I have gone down the rabbit hole. NFTs, remember that time I went down the NFT rabbit hole? I've learned my lesson. Not anymore, because I'm thinking I know something special compared to someone else, but I didn't.
Right. Yeah. Well, yeah, and this is one of the lovely parts about real estate. The person you are most likely to buy from is an owner-occupier. It's not an investor who is disposing of a lemon necessarily. It is just someone who's upgrading, downgrading. But in the share market, that's not the case. Someone else believes it's a lemon and you're buying it.
That's it. And like from this, we just want to, I guess, give our experience, what we've been through, so you can learn from it, and hopefully, some people will. But I guess the other bit is, how do you decide for yourself? So I'd say, what's your risk tolerance? And I think for me, I always say have a cash buffer, be it 6 months, be it 12 months, always have money as backup just in case you lose your job, or you want to start a business, or you want to go traveling, or you're buying a new car, starting a family, whatever it might be. Have your buffer. That's the first step. Not going to a broker. Get your cash flows in order. That's number one. Cash flow, king.
Good advice.
I've just seen it. A lot of people come through and I'm like, what's your surplus? Yeah, I got no idea.
Yeah.
But you want to invest in property.
Yeah, you're just asking for trouble, aren't you?
You do. You need to factor in, because how many people have been hurt by trying to accumulate and then the rates double?
Mm.
So assess your risk, and do you want to be more hands-on or passive? Your cash flow needs, as I discussed, like what's the balance of income and growth that you need, because it is a balancing act. And with property, the higher yield that you go, the areas you limit yourself to capital growth. There's obviously this push about trying to find a property that costs me no money, but it's very difficult to do today's environment with the rates the way they are.
Yeah, like you hit it on the nail on the head there. You are limiting your opportunity chasing those high cash flows.
Decide how comfortable you are with leverage. So I just bring it back to, I know people are worried about debt. Buffer, work out what your surplus you're saving before you buy a property, and what is that going to change by after you buy the property. So an example would be, I'm saving $2,000 a month. I've got no big changes coming up. After I buy that property, my surplus is going from $2,000 down to $1,000. So I'm not going into any negative cash flow territory.
Right. So that in that example, the property is costing you $1,000 a month.
Correct.
Yeah.
Where you might say, look, I'm quitting work tomorrow. My surplus is going from, let's say, $2,000 a month down to negative $5,000 a month. You need to factor these things in, and just choose the best asset mix based on your lifestyle and goals. So, for example, let's say, Jez, going to 3 days a week at the end of the year.
What?
I'm working only 3 days at the end of the year. So for me, my cash flow is going to reduce because I'm not working as much. So I might need more yield type assets potentially. So it's just, again, find that balancing act. Conclusion. I think a mix of both can be a smart strategy, but again, just work out what is best for your circumstances. And I'm happy that we spoke about paying off the debt. So do you keep your money just against a mortgage, get a bulk standard risk-free return at, let's say, 6%? Or are you going to go for more of that risk and take on leverage or go into another asset class? Pick the assets that suit your lifestyle and mindset, similar to point 2. Just finding what works best for you.
Yes. Well, I think I mentioned at the end of part 2 how I still like property because of its the ease with which you have to outperform the national growth rate, the benchmark. You know that fund managers have been using algorithms to trade for quite some time in the share market. It's less common in the property industry, although it's becoming more popular. If someone if there was a fund manager who said, "Oh, look, we've been able to beat the index by 2% per annum for the last 5 years," they would be shooting off fireworks, beating their chest. Look at me, look at me. But in real estate, it is pretty easy to outperform the national growth rate by a much bigger margin. In fact, if someone came to me and said, "Oh, Jeremy, I've got an algorithm you can use to trade real estate and it'll put you 4% above the national growth rate," well, I would say to them, "Oh, sorry to hear that. Keep trying. Chin up. You'll get better," because that is nothing. The algorithms that are around today, the competitive space, we're looking at by how much above double the national growth rate are you getting. That's the difference. So that spreadsheet you put in like 5.4% as a conservative estimate, we'd be talking about double digits there. And in that case, the return on investment just explodes. It becomes no contest. So my big argument for property, it's not about the leverage, which is better. It's not about the control that you have. It is about the opportunity, how easy it is to outperform the benchmark. If you are highly leveraged with one of these Vanguard indexes, you are going to get the average because that's what it is. But to outperform in property, you can still get a bog standard mortgage, bog standard rate of gross rental return net yield, but then the capital growth can be miles ahead. And it's very easy, even without an algorithm, just buy a house in an established area and you can easily beat that ROI. So that's what I like about property, the potential, the ease with which you can outperform the benchmark.
For me, it's that set and forget approach. Set and forget, especially just right after COVID when property was going great guns and you're making money while you sleep. It was just easy, wasn't it? And you don't make any rash decisions. You're not getting valuations every day. With shares, you might check on it every day and you're a lot more inclined to make impulsive decisions. Oh, I'll sell that because it's gone down, and then it goes up and you're like, I shouldn't have sold it. And there's a lot more mind games, I find, for me anyway. Not everyone's the same, but I just found property was, what I learned was I just love the fact I'm making money while I sleep. My financial future is going to be safe. And I just love having a lot of that exposure to, I guess, the property market. But with shares, it was just wild because it's like the index funds, I think, are a lot better. I think Vanguard are doing a great job and other index funds out there too. But it's just more with if you buy individual stocks so that you can easily just sell down like that.
The liquidity.
Just the rash decision. You hear on something in the news, oh my God, I've got to sell everything now, sell down. And then I'm like, oh, maybe I should have kept it. And it's just a lot more. But property, forget it, pay it. You don't hear about it. Valuation every year, fantastic. But where it can hurt, you buy in the wrong area.
Yeah, that's right. Yeah. But in your case, it sounds like because you don't get an update on the value of your property every day, that's actually a helpful thing. Whereas you can always check the value of your shares every day, every hour. Every
hour from when when the markets are on. But Jez, I think it was a good series. Hopefully everyone found a lot of value. I know it's not going to be for everyone, but I think it's important for us to at least have this type of episode just so we can always refer back to it if anyone wants to sort of see it and get our view. But where can listeners go for more resources?
Well, you can click on subscribe and hear from us again really soon. You can click on share, and if someone else is arguing with you over shares versus property, maybe they need to see this. It was a bit of an eye-opener for me doing that data, so that was helpful. And if this is the sort of content you find interesting, give us a like, let us know.
Yeah, if there's any topics you'd like us to explore, podcast at suburbdata.com.au, or just leave some comments in the comments section. Subscribe, like, share to the world. Thanks for tuning in and see you in our next episode. Bye for now and take care.